What if you bought one stock and never sold it? Not for a year, not for a decade, but for life. It sounds crazy in a world where people switch phones, jobs, and stocks faster than ever. But the smartest investors, the ones managing billions, play a very different game. They're not chasing hype. They're buying businesses they believe in so deeply, they never want to let go. And thanks to 13F filings, we can actually see what those billionaires are holding. Every quarter, they're legally required to disclose their biggest moves, giving us a rare look behind the curtain. In this video, I am looking at 5 legendary investors: Warren Buffett, Bill Ackman, Michael Burry, Howard Marks, and Mohnish Pabrai, and the one stock each of them has held or backed for the long term, not for a trade, for a legacy. I'll break down why they chose these companies, what makes them so unique, what makes them so durable, and most importantly, what does it mean for you as an investor? Because if you had followed them and put just $10,000 into each of these stocks 15 or 30 years ago, your financial life would look very different today. One of them can turn that into $440,000. Another one is printing royalty checks from the Beatles and Taylor Swift and can grow to $228,000. And another? It's so misunderstood, it's trading at less than 1/3 the value of its own assets. This isn't about timing the market. This is about understanding it. So let's begin with the man who's made more everyday people rich than anyone alive, Warren Buffett. Warren Buffett has called Coca-Cola one of the best investments he's ever made. And it's not just a line. He's backed that belief with over 3 decades of conviction and counting. In 1988, just months after the Black Monday crash, while most investors were scrambling out of the market, Buffett was quietly buying. Not tech, not growth stocks, soda. By the time he was done, Berkshire Hathaway owned over 6.2% of Coca-Cola. That initial stake cost him around $1.3 billion. Today, that stake is worth more than $27 billion. And here's the kicker. Coca-Cola now pays Buffett over $700 million a year, just in dividends. That's more than half of his original investment, paid back every single year in cash. So, why Coca-Cola? Because Buffett isn't just looking for growth, he's looking for certainty. Coca-Cola is a global powerhouse, sold in 200+ countries, with a brand recognized in almost every household on the planet. It's not just about Coke itself. The company owns Sprite, Fanta, Minute Maid, Smartwater, and dozens of other billion-dollar beverage brands. Financially, it's a cash machine. Revenue, $47 billion. Net income, $10.7 billion. Free cash flow, $4.7 billion. Gross margin, 60% plus net margin, 23% plus dividend yield, 3.15%, with 62 years of uninterrupted increases. Even in recessions, people don't stop drinking Coca-Cola. It's cheap, familiar, and emotionally sticky. It's also capital light. The company relies on bottling partners, so it scales without burning massive capital. Buffett also loves predictability, and Coke delivers. It doesn't rely on economic cycles. It doesn't need constant reinvention. It just quietly prints profits year after year. Even its debt, around $44 billion, is fully supported by stable cash flow. And with an A+ credit rating, it can borrow cheaply anytime it wants. But what does this mean for the average investor? And how do the numbers look? Back in 1988, Coca-Cola stock was trading around $2.72 per share, split adjusted. Today, it trades around $70, almost 27% higher in price alone. Using that growth, we can calculate the compound annual growth rate, or CAGR, at about 10.5% per year. And that doesn't even include the steady dividends Buffett collects. If you factor those in and reinvest them, the real CAGR jumps even higher, closer to 11%. Now let's simulate what this means for the everyday investor. If you had invested $10,000 in Coca-Cola back in 1988 and let it compound for 30 years at that same 10.5% rate, you'd be sitting on nearly $200,000 today. Even over the last 15 years, the same $10,000 would have grown to over $44,000, a more than 4x return, all while holding one of the most stable, globally recognized brands on the planet. Buffett didn't chase fads. He bought a company with durable advantages, sticky customer demand, and reliable income. And then, he waited. No trading, no panic, just time, dividends, and compound growth. That's the blueprint of a forever investor. Next up is Bill Ackman's pick, and he looks for cash flow. And few companies generate more predictable, scalable, and long-lasting cash flow than Universal Music Group. UMG isn't a tech startup. It's not hype riding. It's doing something far more powerful. It owns the music we all listen to and gets paid every single time a song plays. Taylor Swift, The Beatles, Drake, BTS, Queen, Rihanna. UMG owns the rights to their music, and when a song is streamed, used in a movie, performed live, or sampled, UMG gets paid. Ackman made UMG a top position in Pershing Square in 2021, calling it a forever compounder. He sees it like real estate. But instead of collecting rent from buildings, UMG collects royalties from culture, and it collects them for decades. Let's break down the numbers. Last year, Universal Music Group generated $11.83 billion in revenue. That's up from $7.43 billion just 5 years earlier. That's a compound annual growth rate of over 10%. Its net income, a solid $2.09 billion, more than double what it made just 2 years ago. EBITDA came in at $3.47 billion, giving it an EBITDA margin of around 30%, extremely strong for a media company. And the most impressive part? UMG generates a 14.1% free cash flow margin, meaning a huge portion of every euro earned turns into spendable cash. It also pays a 2% dividend with a comfortable 45% payout ratio. That means room to grow. Ackman loves this. He wants companies that return capital and reinvest intelligently. UMG is also improving its balance sheet. Its debt dropped from over $3.5 billion to $1.9 billion. That's rare. Most content businesses are leveraged to the sky, not UMG. So how would a regular investor have done? When UMG went public in September 2021, it was priced at around $18.50 per share. Since then, the stock has steadily climbed, trading at over $27 today. And that's before counting dividends. If you run the math, that's roughly a 45% gain in under 4 years. But we're not just looking at gains, we're calculating compounding. Using that increase, UMG's compound annual growth rate, CAGR, comes out to approximately 11% per year since its IPO. This reflects slow but steady appreciation, fueled by global licensing deals, artist catalogs, and subscription platforms like Spotify and YouTube. So what would that mean for a regular investor? If you had invested $10,000 in Universal Music Group when it went public in 2021 and it compounded at 11% annually, in 15 years, it would grow to nearly $47,000. Stretch that timeline to 30 years, that same $10,000 turns into over $220,000. Not explosive, but steady. And that's during one of the worst tech and media corrections in years. The future, however, looks very different. Streaming is growing globally. Music catalogs are becoming high-value financial assets. New AI tools are creating new monetization layers, and UMG is the toll booth on all of it. Over the next decade, analysts expect 15% plus long-term EPS growth, and Ackman knows this. Content is king, but owning the content, that's empire level. Universal's valuation today sits at a PE of 23.7, with an upside price target of around 15% in the next 12 months. But that's not why Ackman is in. He sees UMG as a multi-decade compounding machine with cash flows that are protected from inflation, downturns, and changing tastes. Because music, unlike most products, never expires. For regular investors, UMG shows that long-term wealth isn't just built on innovation. Sometimes it's built on timeless culture and royalty checks that never stop coming in. Next pick is from someone who predicts market crashes. Michael Burry. Michael Burry is known for bold bets, but when it comes to long-term wealth, his approach is often surprisingly conservative. He's not always swinging for the fences. Sometimes he's playing defense. And one of his most consistent bets is on healthcare, specifically HCA Healthcare, the largest for-profit hospital operator in the United States. HCA runs over 180 hospitals and 2,400 outpatient facilities across 20 states and the UK. This isn't a flashy, high-growth tech play. It's a healthcare juggernaut that generates cash flow year after year no matter what the economy's doing. Think about it. When markets crash, people stop spending on vacations or gadgets. But they don't stop needing surgery or emergency care. That's why Burry likes it. Let's go through the numbers. In 2024, HCA reported $70.6 billion in revenue. That's up from $64.9 billion the year before, a steady 9% growth. Net income, a healthy $5.76 billion. That's a net margin of 8.2%, which might sound modest, until you realize how reliable those earnings are. Year after year in both bull and bear markets. EBITDA came in at $13.90 billion, and free cash flow hit $5.64 billion, showing that after all expenses, HCA still has serious cash left over. Debt is the biggest concern. The company carries about $45.2 billion in total debt. But here's what matters. That debt is matched by consistent revenue and high-quality recession-proof assets. HCA also has a strong operating margin and excellent debt service coverage, meaning it can pay what it owes without breaking a sweat. Valuation-wise, HCA trades at a PE ratio of 16.8 and an EV/EBITDA of 9.0. Not dirt cheap, but more than fair for a cash-printing, recession-resistant business. Its ROIC, return on invested capital, sits around 18%. That means every dollar HCA reinvests brings back nearly 20 cents in profit. That's excellent, especially for a hospital system. And the company has been buying back stock aggressively, reducing share count and increasing shareholder value without relying heavily on dividends. It's rewarding investors quietly, but powerfully. Now let's look at what that means for someone who followed Burry's logic. In early 2010, HCA was trading around $18 per share. Today, it trades above $377. That's more than a 20x increase. When you plug those numbers into a KGR calculation, HCA has compounded at nearly 19% per year over the last 15 years. But let's stay conservative. To be safe, we'll use a 13.5% KGR. Still impressive, and more realistic for forward-looking projections. So let's say you invested $10,000 in HCA Healthcare today, and the stock grows at that 13.5% rate going forward. In 15 years, that $10,000 would grow to nearly $66,000. Stretch it to 30 years, and you're looking at over $440,000. Burry isn't buying HCA because he thinks it'll be 10x next year. He's buying because in a stormy market, healthcare is a fortress. People always need it. Governments support it, and in a world where uncertainty reigns, hospitals stay full. For regular investors, HCA teaches one of Burry's core lessons. Sometimes the best offense is a strong defense. But while Burry leans into stability, another legend is doing the opposite. Howard Marks' pick is chaos, and he's doing it on purpose. Howard Marks built his reputation by going where others won't. He specializes in distressed assets, companies that look like disasters from the outside, but have hidden value underneath. And one of his biggest bets today? A struggling telecom giant, Liberty Global. Liberty Global owns broadband, wireless, and television networks across Europe and Latin America. It operates major telecom brands in the UK, Germany, Switzerland, Belgium, and other key markets, connecting over 85 million people to the internet. From the outside, it doesn't look pretty. Revenue has been declining at 17.1% annually over the last 5 years. Subscriber growth is flat, and investors have dumped the stock, assuming it's a melting ice cube. But Marks sees something different. He sees value. Liberty Global brought in $4.34 billion in revenue last year. More importantly, it produced an EBITDA margin of 79%. That's not a typo. For every dollar earned, the company keeps nearly 80 cents in core operating profit. That margin is higher than Apple, higher than Meta, higher than Google, and it's generating free cash flow, around $1.6 billion last year, with solid operating leverage. Yet despite all this, the stock is dirt cheap. Its price-to-book ratio is 0.3, meaning the company is trading for less than 1/3 of the value of its tangible assets. That's what Mark loves. He's not buying growth. He's buying assets. Fiber networks, cell towers, data centers, for pennies on the dollar. And Liberty isn't sitting still. It's been aggressively buying back shares, reducing outstanding stock by over 20% in just a few years. It's also been selling non-core assets and using the proceeds to pay down debt and consolidate operations. So why has the market punished it? 2 reasons: high leverage and falling revenues. Liberty carries a lot of debt, but that's normal in telecom. Every tower and fiber mile is financed. The key is cash flow, and Liberty has it. It's also navigating a difficult environment. European telecom markets are heavily regulated and slow to grow, but that's also what creates the opportunity. When others exit, Marks enters. Now, imagine you followed his thinking. Back in late 2008, Liberty was trading at just $282 per share. It once traded above $50, but today it hovers below $10, even after its major decline from previous highs. That's a 3.4x return in raw price, but the real story is in the buybacks. The company has repurchased over 50% of its outstanding shares over time, enhancing per-share value. Factoring it all in, the compound annual growth rate over the last 15 plus years lands around 8.5%. That includes the effects of asset sales, capital returns, and the structural advantages of owning critical telecom infrastructure. So what does that mean for a regular investor? If you had invested $10,000 in Liberty Global back in 2008 and it compounded at the same 8.5% rate going forward, in 15 years it would be worth around $34,000. In 30 years, around $120,000. Even after a brutal decline from all-time highs, the long game still works, because Liberty hasn't stopped producing cash. It's just been ignored. Howard Marks is famous for saying, "You can't do the same things as everyone else and expect to outperform." And that's exactly what Liberty Global is. A classic contrarian play. Unloved, undervalued, but printing cash. So while others look for flash, Mark looks for substance. But the final investor on our list, he's looking for something even rarer. An old-school commodity business that's still wildly profitable. Let's wrap up with Monish Pabrai and his unlikely bet on coal. Monish Pabrai doesn't care about what's popular. He cares about what's profitable. And that's why he's making one of the most contrarian long-term bets in the entire market. Coal. Not just any coal, though. He's betting on Warrior Met Coal, a company that produces and exports metallurgical coal, the rare kind used to make steel. This isn't the coal burned in power plants. It's the type that forms the backbone of global infrastructure: bridges, factories, skyscrapers, pipelines, trains. Without it, modern industrial growth comes to a halt. And right now, there's no scalable alternative. Despite ESG pressures, green innovation hasn't cracked a substitute for met coal. That gives Warrior a durable niche. Last, Warrior generated $1.53 billion in revenue. While down from 2022 highs due to softening coal prices, that's still strong for a cyclical producer in a challenged commodity sector. Its EBITDA hit $447 million, translating to an EBITDA margin of around 29%. That's a standout figure, better than many tech companies. It signals tight cost control and operational discipline. Net income was $250 million, and while free cash flow dipped negative at $89 million, that's largely due to capital expenditures aimed at expanding output and streamlining logistics. These are the kinds of short-term sacrifices that fuel long-term scale. And unlike most commodity businesses, Warrior isn't buried under debt. Total debt, just $173 million. That gives it a debt-to-equity ratio of 0.1, virtually unheard of in the mining industry. Its balance sheet is a fortress, offering flexibility no matter how the coal cycle turns. Pabrai isn't in this because Warrior is one of the last pure-play met coal producers with global export strength, low costs, minimal debt, and the ability to print cash in strong markets. Let's run the simulation. Since going public in 2017 at around $19 a share, Warrior Met Coal has steadily climbed to over $43, even with all the industry headwinds. That's more than a 2.2x increase in share price, powered by high margins, lean operations, and strong discipline on capital allocation. When you run the numbers, that performance translates to a compound annual growth rate of about 10%. Not bad for a sector most investors wouldn't touch. If you invested $10,000 into Warrior Met Coal back in 2017, and it continues to grow at a 10% CAGR, in 15 years, it would grow to just over $41,700. In 30 years, it would cross $174,000. And that's the essence of Pabrai's strategy. Low risk, high uncertainty. He's betting that while the world debates coal's future, Warrior will keep quietly shipping, earning, and compounding. Eventually, the market may come around. Until then, he's happy collecting cash and waiting. Coal might not win headlines, but it still builds the world. And for patient investors like Pabrai, that's more than enough. So, what do Buffett, Ackman, Burry, Marks, and Pabrai all have in common? They don't follow hype. They follow conviction. They're not trying to guess what stock will pop next week. They're asking deeper questions. Where's the cash flow? What assets are undervalued? Who has pricing power? What will matter 10 years from now, not just tomorrow? Buffett bought Coca-Cola in 1988, just months after the Black Monday crash. Ackman bet on music through Universal Music Group. Burry prepared for rough seas. Marks leaned into fear, scooping up Liberty Global at bargain bin prices. Everyone else saw telecom in decline. He saw undervalued infrastructure with 80% margins. And Pabrai betting on metallurgical coal through Warrior Met Coal. Each of these investors is buying for different reasons. But together, their moves paint a powerful picture. The best investors don't react. They prepare. And here's the best part. You and I can watch all of this in real time. Through 13F filings, we get to peek into the portfolios of some of the smartest investors alive. We can see what they're buying, what they're holding, and sometimes what they're avoiding. It's insight, and when used wisely, it's a massive advantage. You don't have to copy their portfolios, but you can copy their mindset. Look deeper, think longer, and when fear takes over the market, see if there's something valuable left behind. Want to know why the upcoming recession could be a Trump-planned recession? Click the video on screen to find out why.